In this video, we'll do a deeper dive in understanding what are the different components of GDP. Now, recall from the last video that the national income accounting or the national income identity is stated as follows. If Y is GDP, this is equal to 4 different components, or it can be categorized as spending on 4 different components. There's consumption, there's investment, government purchases, and net exports. So here we're going to talk about what do we mean by consumption. So consumption is the spending by households on goods and services. So households spending on goods and services. One thing to remember here is that if you're buying a new home and you're a household, that is not going to be counted under consumption, but under investment. Okay, and so anything like goods that are durable, for example, refrigerators, automobiles, appliances, and other types of non-durable goods such as food and clothing, and services like dry cleaning services, haircuts, doctor's visits, and things like that, all of that is going to be counted under consumption. So this is going to include durable and non-durable expenses. I should say goods expenses, and also services. Okay, and it is not going to include purchases of new housing. Okay, now household spending on education is also included in consumption itself, even though one might argue that education is an investment, but that's not how we're thinking about it. Okay, so so education is counted in consumption. Okay, and just a note on, since we're talking about housing as well, while new housing is not counted in consumption, your rent payments are. Your rent payments are counted in consumption itself. Next, we talk about investment. Now, investment is the purchase of capital goods. By capital goods, we mean purchase of capital goods. This is not referring to financial investment in stocks and bonds, etc. Okay. But capital goods are goods that would be used in the future to produce more goods and services. Okay, so investment is typically the sum of purchases of 3 different types of investment. The first type is business capital. So this is spending on business structures, equipment, and intellectual property products. The second one is residential capital. And you can almost guess what this is. Residential capital is, like a landlord's apartment building, a homeowner's personal residence. So basically, this is any type of purchase of a new house or any type of condo is going to fall under this type of investment. And the third type that we see is inventory. Okay, so anything that is produced but is not sold is going to fall under inventory in that year. So remember that these are the 3 types of capital goods that are counted under investment. Next, we talk about government purchases. Government purchases include spending on goods and services by different types of government. So these could be your local government, these could be state governments, and this could be the federal government. Okay, so all spending on goods and services that are purchased by the government falls in this category. The thing to remember here is that we are not going to count any type of transfer payments. Transfer payments are things like, examples are Social Security payments or unemployment benefits to a person who is laid off. We will not be counting these in GDP because these payments, once you receive those, are again going to be, this money is always going to be spent on goods and services by household. So let's say your grandma or grandpa receives a Social Security check, then they're going to spend on goods and services, and that is going to be counted as consumption anyway. So we don't want to do any double counting, so we are going to exclude transfer payments from government spending or government purchases. Okay, but obviously if the government is spending on national defense or purchasing medical equipment and things like that, it is going to be counted in GDP accounting. Okay, and finally we talk about net exports. Now we have covered this in chapter 3 where we talked about exports and imports, but just to reiterate that point, exports is basically the foreign spending on the economy's goods and services, and imports are the portions of consumption, investment, and government spending that are spent on goods and services that are produced abroad. And that is the reason why net exports is defined as X minus M, where X is exports and M is imports, and we're subtracting off that component which is not produced here from GDP accounting.